How much can you borrow against your own stocks before one bad month takes the whole account? At Ground Truth, we take the money ideas your feed keeps serving you and we crash test them on real data. Today, margin. Buying stocks with borrowed money. This summer, that idea delivered margin calls to 1.2 million South Korean accounts in a matter of weeks. So we built 80 simulated margin accounts and drove them into every major crash since 2019. Here is how the 2022 bear ended. Every concentrated account at 2-to-1 leverage was force sold by its broker. The 5-chip basket finished at minus 58%, gone. A diversified account, same 2-to-1, same dates, finished 21.5% ahead, same leverage, same dates, opposite endings. The line between the two endings is one line of arithmetic. Your broker runs it every night. Most people who borrow have never run it once. By the end of this video, you will run it in your head, and you will see the one setting in our yard that survived every wall we own. 3 questions. Keep them. 1. How far does your account fall before the broker sells it for you? 2. Same leverage, same dates. What decided who survived? 3. Is there an amount of leverage you actually get to keep? This is the audit of margin. This is Ground Truth. Quick note before we start. This is education and entertainment, and it is not financial advice. We test ideas here. We do not tell you what to do with your own money. Why win once when you can win twice? You already did the hard part. You picked the winners, the chips, the future. Now the broker will lend you money against them at the click of a button, and every point your stocks go up, you make 2. It is your conviction, amplified. We are going to be honest about this part because the pitch is not wrong about the good years. It is only silent about one number. Here is the good year, measured. Our test yard's bull window runs from January 2023 through June 2026. The AI chip basket, unlevered, made over 1,100%. At 2-to-1 leverage, over 2,200%. Leverage is a return engine in a rising market. That is measured on screen, and it is exactly why what happens later happens. A caveat, and it cuts against the prettiest number we will show today. Those chip returns are hindsight. We picked the famous names everyone knows because everyone knows them now. Nothing in this episode is a forecast that chips go up. The question we are testing is not whether the stocks win. It is whether the account survives the ride. And this summer, that question drove into a wall, at national scale, on live television. The sequence, in order, as reported. In January, South Korea's regulators approved a product nobody should test on real people, an ETF giving 2-to-1 leverage on a single stock. Trading opened in late May. Over the next 7 weeks, retail investors put in an estimated $9.4 billion, most of it on 2 chipmakers. In June, the Korean market peaked. By the middle of July, the chip trade had turned, and the reporting says 1.2 million retail accounts had hit margin calls, up to 360,000 accounts forcibly liquidated. Citi's estimate of the retail losses on the leveraged products, $38.7 billion. By late July, the sell-off had spread through the global chip sector, reporting put the lost market value above $1 trillion. Those are reported numbers from the financial press, and we are citing them, not measuring them. What we can measure is the machine underneath them. Because the machine is arithmetic, the arithmetic is public, and it was public the whole time. So, we built the crash test. But first, you need the rule the whole episode turns on, what a margin call actually is. 2 minutes. Korea just priced those 2 minutes at $38.7 billion. When you buy stocks with borrowed money, the loan has a name, margin. Picture the simplest case. You put in $10,000, the broker lends you $10,000 more, and you hold $20,000 of stock. Half of it is yours. That is 2-to-1 leverage. The rule that governs it is called the maintenance requirement. Your slice, what is really yours after subtracting the loan, must stay above a set fraction of the whole account's value every day. We modeled 30%, which is what mainstream brokers actually require, give or take. Fall below the line, and the broker does not send a sternly worded letter. The broker sells your stocks, at whatever the price is that day, until the math works again. That is a margin call, and in a real crash it usually means forced liquidation, sold for you, at the bottom whether you agree or not. Here is the part almost nobody borrows with in mind. The drawdown that triggers that sale is not a mystery. It is set in advance, by one number, your leverage ratio. We call it the liquidation line, and you can compute yours tonight. At 2-to-1, your stocks only have to fall 29%, and both bears in our own yard cleared that bar, and the account is gone. At 1.5 to 1, the line sits at minus 52%. And if you only borrow a third of your own money, minus 65, minus 29, minus 52, minus 65. Those three numbers are the whole formula for the three settings anyone actually uses. Memorize the shape, not the digits. The more you borrow, the shallower the dip that ends you. That is question 1, answered. Before we have run a single simulation, how far does your account fall before the broker sells it for you? Exactly as far as your leverage ratio says. It was never a secret. It is just arithmetic. Nobody runs while the market is going up. Which leaves the real question. A line is only dangerous if the thing you own actually crosses it. So, what do real portfolios actually do in real bears? That is what the 80 accounts are for. Korea's bill so far, as reported, $38.7 billion. Here is the machine that printed it, rebuilt in our lab. The test yard. 5 portfolios, real prices, from our own survivorship-free data store. 49 million ticker days, including the dead companies most backtests quietly forget. The vehicles. 1 account holds only Nvidia. 1 holds only Micron, the closest American cousin to the memory chipmakers Korea levered. 1 holds the famous 5-chip basket, Nvidia, Advanced Micro Devices, Broadcom, Micron, and Marvell. 1 holds 10 household names across 8 industries, the boring account, and the last one just holds the S&P 500. Each vehicle runs at 4 borrowing settings, and here is the currency we will name them in for the rest of this video. No borrowing. Borrowing a third of your own money. Borrowing half again, the 1.5 setting. And the full 2 to 1. A borrowed dollar for every dollar of yours. Every vehicle drives into the same 4 windows, the 2020 crash, the 2022 bear, the bull run you already saw, and the whole ride from 2019 to the middle of 2026. Buy at the start, hold, never rebalance. The broker checks the account every single day at the day's lows. 80 accounts. Everyone reported. And before we ran a single one, we wrote down 7 predictions and locked them. A wager against our own yard. Keep score. We will read the result off at the end. Let me show you the wall that decides the episode. Not a typical window, the harshest window we could honestly choose. Buy in November 2021 at the top of the chip euphoria and hold through the end of 2023. We chose it because it is the exact position of the person who levers up after a big run, which, as we will see, is the only person who ever levers up. First, what happened to the stocks in that window? No leverage, nobody forced to sell. Nvidia fell 68% from its peak and finished the window up 50%. The 5-chip basket fell 54% and finished up 25%. Micron fell 50% and finished slightly up. Hold that. Every one of those drawdowns healed. If nobody could force you to sell, the 2022 bear was a bad dream you slept through. Now, add the borrowing. 2 to 1, same window. The Nvidia account, force-liquidated 2 months in, on January 21st of 2022, final result, minus 60%. The Micron account, liquidated that June, minus 63%. The 5-chip basket, liquidated that April, minus 58%. At 2 to 1, every percent the stocks fall is roughly 2% of your own money. That is how a 29% dip becomes a 60% whole. And the boring account? 10 names, 8 industries, the same 2 to 1 loan, the same dates. Its worst drawdown was 16%, the line sits at 29%, and it cleared it with room. Final result, 21.5% ahead. There is the whole episode in one pair, minus 58, liquidated, plus 21.5, held. Same leverage, same dates, opposite endings. The loan did not decide and the calendar did not decide. The only thing left is what the account was holding. That is question 2. Answered, same leverage, same dates. What decided who survived? The decider was concentration. A concentrated chipbook swung between 50 and 68% in that bear, past the 2 to 1 line, past the 1.5 line, and in Nvidia's case through even the gentle one. The boring book swung 16%. Diversification is not really a return decision. It is a decision about how much leverage you get to keep. And the accounts that died, remember what their stocks went on to do. They recovered, completely. The liquidated accounts were not holding losers, they were holding winners, with a loan against them. We have a name for this, the forfeited recovery. The stock came back, the account did not. That was the grinding bear. That was also the good news, and here is a preview of the fine print. The account that did worst in this entire window was not the reckless one. The yard has 3 more findings, and each one removes an escape route you are probably drafting right now. Escape route 1, so I will just use less leverage. Sensible. Mostly true. And here is the exception, measured in that same 2022 bear, the cautious Nvidia account. The one borrowing just a third ended at minus 85%, worse than the reckless 2-to-1 account, which lost 60. Here is how. The reckless account breached its shallow line early, in January, near the top. It was executed at a smaller loss. The cautious account had cushion, so it survived January, survived the spring, and rode all the way down to the September lows, where it finally breached, with 9 more months of interest on the loan at a far deeper liquidation price. The later call is the deeper cut. A ratio that still breaches is not safer, it is slower. The only safe ratio is the one that never breaches at all. Escape route 2. The line is at minus 29, my index only fell 27, I would have survived. The margin clerk has fine print. While your stocks fall, your loan does not sit still, it compounds at interest every day. In our test, the S&P account at 2-to-1 was liquidated in October 2022 at a drawdown of 27% inside its own theoretical line. The loan had spent 11 months quietly growing while the collateral shrank. The liquidation line you compute tonight is the best case. Time makes it stricter. Escape route 3, fine. Double leverage only fails if you concentrate. A diversified index at 2-to-1 is safe. The 2020 wall says no. COVID fell too fast for everyone. At 2-to-1, the S&P account was liquidated on March 18th of 2020, the 10-name account 2 days later. Within days of each other, in a year the market finished up, nearly every 2-to-1 vehicle in the yard was gone. Somewhere in our yard, 2-to-1 failed for every kind of account. It is simply the setting at which normal market history is fatal. Now, one cell survived that COVID wall, and you deserve to see it, because it explains who actually gets hurt. The 2-to-1 Nvidia account lived through 2020. The reason, that window starts in January, and Nvidia ran up hard before the crash. The account met the wall with a cushion of profits under it. The call is measured from where you bought, not from the peak. Which sounds comforting, until you remember who actually levers up. Nobody borrows at the bottom. You borrow after the run, when the cushion is smallest and the euphoria is loudest. Korea's 2-to-1 ETFs opened for trading in late May. The Korean market peaked in June. Also, in the interest of full disclosure, one cell in our grid beat our written wager. We predicted the Micron account at 1.5 would be liquidated in the 2022 bear. It survived. By 2.1 percentage points, we recorded the miss. And we would not call that surviving a crash test. We would call it a coin landing on its edge. So you are probably thinking, fine, then I will buy the version with no margin loan, the version that cannot be called. Korea thought so too. 2 more characters claim they have solved the liquidation line. Korea bought the first one. The second one is sitting in a brokerage account near you. The first, the leveraged ETF itself. Its defenders will point out correctly that the wrapper takes no margin loan in your name. It resets its 2-to-1 every single day, so it can never be margin called. True, we tested it. And to be precise about Korea, the wrapper itself takes no calls. The 1.2 million margin calls came from beside it, from the margin loans traders ran on top of and alongside these products. What the wrapper does instead, it does on its own. In our 2022 chip bear, the 2-to-1 daily reset Nvidia vehicle fell 92% from its peak and finished the window up 15 against Nvidia's 50. Read both halves of that. The wrapper survived the window, and anyone who bought it near the top, which is when Korea bought, was down 92% at the trough, in a product that finished positive. No broker call required. The mechanism has a name, volatility drag. In plain terms, when you double every daily move, down 10 then up 10 does not bring you back to even, it digs a small hole, and every round trip digs it deeper. A volatile chip stock is nothing but round trips. Doubled daily, a survivable drawdown compounds into a catastrophic one. The decay does the liquidating on its own schedule. And in the bull window, that same wrapper multiplied money past 9,000%. The recruiting poster and the obituary are the same instrument. Which one you get is decided by the tape, and nobody sells you the tape in advance. The second character, the hedge. While researching this episode, we corresponded with a real investor, a private person, so no name and no details, who runs a concentrated AI chip book at roughly 1.8 to 1 on margin. He is not naive. He runs a disciplined options. Hedging program, he buys downside protection when specific technical conditions line up, and he buys it while it is still cheap, before fear prices it up. That last part is genuinely good options craft, and plenty of professionals do it worse. We did not test his hedges, and we will not pretend we did. And we can report something better than a guess. When we asked him whether the hedging actually helped in July's sell-off, he told us that without his put spreads, he would have been forced to sell positions at a big loss, to keep his margin safe. By his own account, the umbrella opened, and it held. Read his sentence one more time, because both halves of this episode are inside it. The protection worked, real craft, real payout, credit where it is due, and the sale it prevented was a margin maintenance sale. The storm his umbrella has to keep stopping, every time, forever, is the broker's line, a line his own ratio drew. A hedge is protection you rent, a premium paid over and over, a renewal decision you have to get right every single time. We call it the rented umbrella. His own risk checklist names a 15 to 20% decline as the point where he would be forced to change the portfolio. Set that beside our grid. A book that a 15% decline can force to change is a book whose ratio is already making the decisions. The ratio he is renting protection against is a ratio he could simply not run. That is not a criticism of his craft. It is an observation about which layer the risk lives in. The umbrella is rented. The ratio is owned, once, for free. Which leaves the question you walked in with. Is there an amount of leverage you actually get to keep? The wager resolved. 7 predictions, locked before the first account ran. 6 hit, 1 missed by 2.1 percentage points, and we showed you the miss. How much can you borrow against your own stocks before one bad month takes the whole account? That was the question you clicked on. Here are its 3 answers. Closed. Question 1. How far does your account fall before the broker sells it for you? As far as the liquidation line your own ratio draws. Minus 29% at double. Minus 52 at 1.5. Minus 65 if you borrow a third. And remember the fine print, interest moves the line toward you every month you spend below your high. Closed. Question 2. Same leverage, same dates, what decided who survived, what the account held. The concentrated books died at 2 to 1 everywhere in that bear, and 2 of the 3 died at 1.5. The boring book cleared every line it was asked to cross. Minus 58 liquidated, plus 21.5 held. Closed. And the boring root cause, crowned before the last answer. Not one account in our yard was killed by a crash. Every single one was killed by arithmetic that was computable before the crash. A ratio times a drawdown, crossing a line printed in the account agreement. The stocks came back. The arithmetic never left. Why do smart people stand past the line? Because every signal that says lever up fires at the top. The bull tape pays you, monthly, to raise the ratio. Our own grid prints 2,000% for doing it. The cushion argument feels true right after a run, which is exactly when the cushion is thinnest. The disaster case looks like a temporary dip, because for the unlevered investor beside you, that is all it is. The market forgives them and executes you, on the same chart, in the same week. And nobody in the chain that sold you the loan is lying. Brokers earn interest on margin, issuers earn fees on wrappers, and the pitch that sells is the bull window number, which is real. The line is just nobody's job to say out loud. What survives from the wreckage? 3 things you keep by name. The liquidation line, run it before you borrow $1, and remember it tightens with time. The forfeited recovery, a margin call, is not losing money faster. It is being removed from the recovery. The drawdown was temporary until the loan made it permanent. And the rented umbrella, before paying rent for protection, ask whether the risk is one you could simply own less of. Question 3. Is there an amount of leverage you actually get to keep? In our yard, yes. And it is smaller and duller than any pitch will ever say. A modest ratio, on a genuinely diversified book, sized so the book's worst historical drawdown still clears the line with room to spare. In our grid, borrowing a third against the diversified accounts survived every wall we own, and so did the 5-chip basket at that setting. Borrowing a third against Nvidia alone still died. Diversification is not about returns. It is about how much leverage you survive. That is an illustration from our simulations, not a recommendation. The disclaimer at the top of this video is doing real work in this sentence. Closed. If you hold a levered book right now, this episode is not a prophecy. Chips may rip higher from here. Our yard says nothing about direction, and the honest reading of our own bull window is that leverage on winners pays, right up until the dates change. The only thing we measured is the line, and where you stand relative to it is a number you can compute tonight from the 3 numbers you already know. What would change our mind? And this is a live bet, not a caveat. Bring us a lever and hold construction on a concentrated chip book that survives both of our bear windows at 1.5 or higher. Or bring us a hedging program whose all-in rent, honestly priced, beats just owning the diversified book at the same net exposure. The lab is open. Send it. In the meantime, the record stands where the yard left it. 80 accounts went in, and the ones that came out were not the ones holding the best stocks. They were the ones whose arithmetic was survivable before the wall showed up. That is where the record stands today. This is ground truth. The machine is always hungry.